Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money world. And let me tell you, our subject today is taking a very interesting turn with digital assets. Today we are diving deep into Predictive Oncology Inc., its latest quarterly report to see how their business as usual stacks up against their brand new and quite bold pivot into the world of cryptocurrency. First off, a quick note before we get too deep into things. As of November 2025, there were just over 3.3 million shares of common stock out there. This is important context as we look at their financials, because when you are talking about per S-hair numbers, knowing how many shares exist is key. Now, let's hit their balance sheet. This is like a snapshot of what the company owns and owes at a specific point in time. As of the end of September 2025, they had about $181,000 in cash and easily convertible cash. That is a decent drop from nearly $612,000 at the end of 2024. This signals they've been spending money, which is expected given their operational shifts. Now this almost made me rub my eyes. Their accounts payable, what they owe to others, surged from about $1 million at the end of 2024 to a massive $2.7 million by September 2025. This can be a sign of the business growing and owing more to suppliers, but it also means they've got a lot of bills to pay. And then there is this line derivative liability, which spiked from zero at the end of 2024 to a staggering $74.3 million by September 2025. This is a huge number and points directly to their new digital asset strategy. It means they have a financial contract whose value is tied to something else. In this case, likely the price of crypto. This is a major indicator of the new risks they're taking on. And when we look at the stockholders' equity section, things get a bit stark. They have a total stockholders deficit of over $77 million as of September 2025. This means that what they owe is far greater than what they own. It is a big negative number that essentially means if they sold everything they owned, they still wouldn't have enough to pay off all their debts. Moving on to how they've been doing operationally, their statement of net loss tells a story. In the 3 months ending September 2025, their revenue was just under $3,700. That sounds incredibly small, but compared to the same period in 2024, it is actually a slight decrease. In the 9 months ending September 2025, revenue was about $116,000, up from about $76,000 in 2024. This modest revenue growth suggests their core business is either stable or very slowly growing, but it is dwarfed by other financial events. And here it is again, the derivative instruments. In both the 3 and 9 month periods of 2025, they recorded a massive loss of over $74 million related to this. This is directly tied to that huge derivative liability we saw on the balance sheet. It means the value of whatever contract this is tied to dropped dramatically. This is an enormous hit to their bottom line. For the 3 months ending the 30th of September 2025, their net loss was over $77 million. For the 9 months, it was a staggering $82 million. These numbers are enormous, largely driven by that derivative loss. To put it in perspective, their total revenue for the 9 months was just over $116,000, and they lost over $82 million. That means for every dollar they made in revenue, they lost hundreds of dollars. Their loss from what they consider continuing operations alone was over $81 million for the 9 months of 2025. When you factor in discontinued operations, it pushes that loss even higher. This highlights that their core AI oncology business is not currently making money, and the huge losses are coming from these complex financial instruments. And when you look at the loss per S-hair, for the 3 months ending in September 2025, it was a negative $107 per S-hair. For the 9 months, it was a negative $136 per S-hair. This shows just how deep the losses are when spread across the shares in the company. Now, let's look at their statement of stockholders' equity. This tracks changes in the owner's stake in the company. By the end of September 2025, we see that massive deficit again in the total column. A negative $77.4 million. This is the result of accumulated net losses over time. We do see some positive activity here though. They issued shares and increased their additional paid-in capital by significant amounts from warrant exercises, and various offerings like registered direct offerings and private placements. This means they are getting money by selling more company stock, which is a common way for companies like this to raise crucial funds. But it also dilutes the ownership percentage of existing shareholders. For example, between December 2024 and September 2025, they saw a substantial increase in their additional paid-in capital, which is largely the money they raised by selling stock. Unfortunately, that gain from selling stock is consistently overshadowed by their net losses. Even with the money coming in from stock sales, their accumulated deficit grows because of the huge operational losses. Let's touch on the cash flow statement. This tells us where the cash is coming from and where it is going. For the 9 months ending September 2025, they used nearly $6 million in cash for ongoing operations. That is less than the nearly $8 million they used in the same period in 2024. So they are burning through cash, but maybe at a slightly slower rate in their core business. On the financing side, they brought in about $4.5 million in the 9 months of 2025, primarily from issuing more stock and warrants. This is crucial for them to stay afloat, but it comes at the cost of diluting existing owners. Interestingly, they actually generated positive cash flow from discontinued operations in 2025, about $825,000, mainly from selling off assets related to those operations. This is a good sign they are cleaning up the house by selling off parts of the business that were no longer core. Now, beneath all these numbers, we find the crucial context in the notes to the financial statements. This is where they explain their new game plan, the Aether Treasury strategy. They are now focused on acquiring and holding Aether tokens, or ATH, the company sees this as creating a strategic compute reserve and becoming an operator on the Aether network, which is designed for GPU compute power for AI and gaming. They adopted this strategy in September 2025 and started buying tokens in October. And this section is absolutely critical. The company openly states there was substantial doubt about their ability to continue as a going concern up until recently. This means there was a real risk they might not be able to keep their business running. They had significant losses and a big accumulated deficit. The good news though is that they recently closed 2 private placements, bringing in about $50.8 million in cash. They believe this, plus their digital asset holdings, should cover their operations for at least the next 12 months. So they've bought themselves some time, but it is a tightrope walk. Another important detail is the 1-for-15 reverse stock split they completed in September 2025. Companies do this to artificially boost their share price to meet exchange listing requirements or make it seem more attractive. All the numbers we've discussed are already adjusted for this split. This is a high stakes part of their story. They were on the verge of being delisted from the Nasdaq stock market because they didn't meet the minimum stockholders' equity requirement and had a low stock price. They got an extension to fix this, and the reverse stock split seems to have helped them meet the bid price requirement. The big cash infusion from those recent private placements is what they're likely counting on to satisfy the equity requirements. It is a constant battle to stay listed, which is vital for any publicly traded company. This note sheds more light on that massive derivative liability. It seems they entered into an agreement to sell warrants in a private placement where investors would pay with ATH tokens. Because the value of this deal fluctuated with the price of ATH, it was classified as a derivative liability. The $74 million loss we saw earlier is the change in the fair value of this derivative, meaning the ATH tokens didn't perform as expected, causing a huge paper loss. This is where we see what happened after the reporting period, and it is massive. On the 7th of October 2025, they closed 2 private placements. In one, the cash pipe, they sold over 4.3 million shares of common stock and pre-funded warrants for about $50.8 million. In the crypto pipe, they issued warrants to purchase nearly 15 million shares in exchange for ATH tokens, with a notional value of nearly $300 million, but a discounted value of around $173 million. This is the core of their new treasury strategy, using a huge influx of capital, some cash and a lot of crypto to fund their digital asset ambitions. They've also brought in DNA Holdings Venture Incorporated as a strategic advisor and asset manager for their digital assets. This means they are not managing this crypto side of the business entirely in-house, but relying on external experts. This is smart given the complexity, but also adds another layer of counterparty risk. End of scroll Accession. So what is the actual story here for Predictive Oncology Inc.? They are in a major transformation. Their core AI oncology business seems to be struggling, generating very little revenue and significant operational losses, which led them to the brink of insolvency. The company was facing delisting from Nasdaq to survive. They've made a dramatic pivot. They've embraced a high-risk, high-reward digital asset strategy, focusing heavily on Ether tokens. They've raised a significant amount of capital through private placements, a large portion coming in the form of cryptocurrency. This influx has provided them with some breathing room and helped them regain compliance with Nasdaq listing rules, at least for now. However, this isn't a magic bullet. They're now exposed to the extreme volatility of the cryptocurrency market. That $74 million derivative loss is a stark reminder of how quickly these assets can impact their financials. They are heavily concentrated in one digital asset, ATH, which amplifies the risk. The success of their entire strategy now hinges on the ATH network performing well and the price of the token appreciating significantly. They are also relying on external managers for their digital assets, adding another layer of risk. While they have secured funding for the next 12 months, their long-term survival still depends on this speculative crypto play paying off, or finding a way to monetize their core business, which seems to be lagging significantly. In essence, Predictive Oncology Inc. has bet the farm on cryptocurrency. It is a high-stakes gamble that could either lead to a remarkable turnaround or a spectacular fall. From a financial health perspective, they are still very weak, with a massive deficit and high operational losses. The crypto holdings offer a chance at outsized returns, but also the potential for catastrophic losses. Alright, that is our breakdown of Predictive Oncology Inc.'s latest filing. What is your take on this bold crypto pivot? Do you think it is a path to salvation or a recipe for disaster? Let me know your thoughts in the comments below. If you found this analysis valuable, please hit that like button. It really helps the channel. And most importantly, subscribe for more deep dives into the world of corporate finance. Don't forget to check out our Discord community in the description for more discussions and insights. Thanks for watching, and we'll see you next time.